You know, there are very many mysteries in life. As I woke up this morning and I looked over the lake, it was a mystery to me how Switzerland avoided the forces of purchasing power parity. Having paid for dinner last night and my eyes were still watering, I wondered why that still remains the case. And as I looked over towards Italy, it's a mystery to many of us, Italian electorate's taste in politicians. But I'm sure that there is an explanation somewhere in life. But I'm going to talk to you about a different mystery today. And that's one which is rather relevant to this conference, which is about challenges and opportunities in investment management. Because my question and the mystery that I'm going to ask you is it's a mystery to me why there are so many asset managers. Now, let me explain a little bit why that's a mystery, and that's not just me being provocative. Decades of academic research, which many of you will see, and also a lot of practitioner research, has shown that active asset management, on average, adds no value. And I say on average adds no value. In fact, what we find is that some managers perform better than others over periods of time, but there tends to be mean reversion, and asset managers are not cheap, and so they charge fees, and as a result, that most of the research has shown that on average, passive investing can do better than active investment, at least in efficient asset classes, in efficient markets where there's relatively good information and there's a large number of people acting in those markets. And yet, despite all that academic research, why do we still see very large pools of capital allocating very large sums of money into assets which are actively managed, especially on the equity side? And although the title of my paper you may be surprised what I'm saying because I'm talking here, it's about investment consultants. I think that this is a part of the jigsaw in this mystery as to why we see so much active management. And what I want to talk about is really the sort of way in which some of these decisions are made. And it's worth remembering that some of the biggest pools of capital, the pension funds and foundations and trusts and other sort of plan sponsors are managed by, or they have the decisions are made ultimately by trustees who are very often not financial experts. And they're ultimately responsible for the decisions of the fund, but they are not necessarily expert in financial affairs. And so consequently, a lot of those plan sponsors use investment consultants. And in a sense, what I'm looking at is really whether those investment consultants add value. But it's worth just standing back from it a moment and saying that there is a conflict of interest facing all consultants in life. Consultants have very little interest in coming forward with simple solutions. That does not generally drive good consulting revenues. And so consequently, the link between my mystery and the research is really that I think that if you believe that the sort of belief in there being good investment managers out there in very mature asset classes is a bit like chasing fool's gold. There's gold in those hills, we've just got to find it, we just need some help to go out there and find the gold. In a way, the investment consultants are potentially the ones who encourage and lead the fund trustees to believe that there is gold out there. Now, this is a paper which is about some big numbers. And I'm not going to this is one of the very few slides you're going to see. These are the numbers which this paper's about. So we're not talking about small sums of money. What you'll find is that if you look at measures of the size of the industry that I'm talking about, which is sometimes referred to as the amount of assets under advisement. Now, as you can tell, I'm English, and I'm a custodian of the English language, and advisement is not a word, but I'm going to use it anyway. But the number of the amount of assets under advisement is about $25 trillion. globally, estimates have shown. So that's the amount of money that investment consultants are advising on. It's also a very, it is the norm. If you look at 94% of plan sponsors use investment consultants. Okay, these are from recent surveys from pensions and investments, which show that the vast majority, almost all these plan sponsors use investment consultants. It's also a highly concentrated industry. If you look at the 4.4 trillion, that's the amount of assets which are advised by the market leader in this industry. And if you look at the share of the top 10 investment consultants, it's about 81%. So this is a very large industry. It's very concentrated, and they have a very large effect upon the whole industry. Now, the bizarre thing to us as academics is that investment consultants have been pretty much below the radar screen. I did a search on the number of academic papers which have been written about investment consultants, and there are 2 before ours. And so that's very bizarre, because academics there's millions of papers written about fund managers, there's thousands written about investment banks, but there's 2 written about investment consultants, despite the fact that they advise $25 trillion of assets, which is interesting in its own right. And so what we did in this research was we basically did something very simple. We said, can we get the recommendations of investment consultants? Because the way it works is that a plan sponsor will say, I want to put, certain amount of money to work in US equities, and the plan sponsor will come along with, or the investment consultant will come along and say, these are my 5 recommended funds that you should put your money into. And so what we wanted to do was to get data on the funds that were recommended versus the funds that were not recommended, and do something extremely simple, which is to say, so were one group better than the other group? Did one perform better than the other? And so that's really what we do in this research. And I'm not going to go into all the details of it, but basically, it's very, very difficult to get this data, because investment consultants make plan sponsors sign confidentiality agreements, which say that they can't give it to people like me. And so what we did instead was we went to a survey which is done every year by Greenwich Associates, who survey investment consultants, and they ask for their recommendations, their top 4 to 6 recommendations across a bunch of assets, and it's segmented by asset type as well. And in this paper, I should be clear that we're only looking at US long-only equity. So those of you who are not working in US on long-only equity, you can breathe a sigh of relief at this stage. It's not about you, but it is about the most efficient asset class, and the largest asset class as well. And the reason for that was the asset class for which there was the longest run of data that we could get. And so this survey covers about 90% of the market in terms of the sort of assets which are advised. Around 2,000 funds are included each year in the survey. And of those, about 21% get recommended at least by one consultant each year, to give you just a feel for the data. There's about 80% that don't get any recommendations. If you look at the average size of the recommended versus the non-recommended products, the recommended are much larger than the non-recommended, which in some ways shows the power of the investment consultants. And it's also, just as a final sort of summary statistic, if you like, if you're thinking about what we're talking about here, the average fees which are charged by these actively managed funds to institutional investors, so these are not retail investors, institutional investors, is about 70 basis points. And this is obviously then, if you're thinking about doing some simple mathematics, then obviously if you take a more passive approach, you could reduce that to single figures in terms of basis points, probably. So you might be looking at 60 basis points of additional fees which are being paid for going into these active products. Okay, so what do we do? Well, we do something very simple, which is sort of what you'd expect to do. So I'm going to take that back. What we do is we actually get this survey, and we ask 3 questions. What determines how they how the investment consultants come to their recommendations, what effect that has upon the flow of assets, and how much value do they add. I'm going to only talk very briefly about the first two. In terms of the way they make recommendations, you might think that it's all about return chasing, that they basically take products which did well in the past and they recommend them in the future. That's actually not the case. They do tend to, it seems like, because we get information also upon other aspects of the asset manager, soft factors about their process and the sort of way in which they communicate to investors and the like. These softer investment factors actually explain most of what determines their recommendations. It's not just a return-chasing strategy. In terms of the second issue about do they have an impact, well, you can get that a little bit from that data, but also you find that if there's a big change in the number of recommendations, either positively or negatively, it has a huge effect upon assets under management. If you get 40% more or less recommendations, you gain about $1 billion in this market. So it's a very large impact. And that's why asset managers care so much about what investment consultants think of them. And so it has a very large effect. Now, what about the main question, which is, do they add any value? Well, what we do is we then take the performance of the recommended funds, we take the performance of the not recommended funds, and we compare them. And what we find is that over the sample as a whole, the products return about 6.3% per annum, and about after fees, and about 7.1 before. But when we split them up into two buckets, we find that the recommended funds, on an equally weighted basis, they underperform the funds that are not recommended by about 1.1%. Okay, so the recommended funds do worse than the funds that were not recommended. Now, I said there that that was on an equally weighted basis, and that's an important basis to look at it. But if you look on a capital weighted basis, you still see some underperformance there, but it's not significant. I should say that that first result is statistically significant at normal levels. Now, on a capital weighted basis, less so. And there's less difference. And that's partly because there's another factor that academic research has shown, which is that large products tend to perform less well than small products. And as capital flows into funds, their performance tends to revert back to the mean. And that's a challenge for all investors. Now, of course, go back to some of those first statistics. This is an industry which is highly concentrated, where the largest player advises $4.4 trillion. Are they going to be wanting to put a lot of effort into digging out that £100 million asset manager when they're actually advising clients with $4.4 trillion under management? Maybe not, which is an interesting issue for plan sponsors as to whether you want to go with the market leader or not when they're more likely to put you into large products which research has shown underperform. But in any case, the bottom line is that the funds that they recommend tend to underperform the funds they don't recommend. We then do a number of other things. I'll tell you about two of them. We look at the ones, you might say, well, maybe some of those funds which are not recommended aren't really sort of institutional type of funds. So we look at the funds which are recommended at least by one investment manager, one investment consultant, and we say, are the ones that have been recommended frequently, how do they perform relative to the ones that have been recommended infrequently? And the ones that are recommended infrequently do better than the ones that are recommended frequently, which is also sort of consistent with this theme. And then we look at what happens when recommendations change, again, because we might be worried about this issue that these are not institutional funds. So we find that we look at when the number of recommendations goes up or down and track them over the next 1 and 2 years. And we say, how do those funds that have lost recommendations do relative to the ones that have gained recommendations? By now, you can probably guess the result. The ones that lose recommendations outperform the ones that gain recommendations. And so this is the sort of the nature of this research, which shows that to some extent, if you're looking at trying to explain whether the investment consultants add value for plan sponsors, it's quite difficult to find that value added. Now, when this research came out, most academic research really flies beneath the radar. Nobody ever really sees it, and nobody much talks about it. Well, the day after this paper was published, this is what happened in the front page of the Financial Times. That was their interpretation. I have to say it's not necessarily our interpretation of the results, but that was their interpretation of the results. This followed up the next day with, again, a title which was nothing to do with us, I have to say, but this discourse carried on for quite some time. It then made its way over the Atlantic, and investment consultants started being investigated there by the financial regulators. And so it has actually surprised us the extent to which this research has struck a nerve. Now, and I think it's partly the fact that investment consultants have been really, as I say, sort of not really researched very much, even though everyone in the asset management industry knows how powerful they are. And if you speak to the fund trustees themselves, that you have an interesting discourse. Now, maybe I've looked at a biased sample, but basically, when I've presented this result to trustee conferences, nobody is surprised. They're completely not surprised, and I say, well, why do you use them? And they say, well, it's really because it's a sort of insurance policy for us, you know? So what we're trying to do is we're good, well-meaning folk without major investment expertise, and we don't want to get sued. And so we employ investment consultants, and they, and that way you don't get sued for using Mercer. And so I think that's part of it. But it goes back to the sort of issues which I raised at the start, which is that I think the bigger issue here is for the trustees as to whether they should really believe in the existence of fool's gold. Because I think that it's probably the case that the investment consultants do sometimes push them in that direction. And so I don't know whether there's a role in life for another film about financial scandals, but just in case there's a movie producer in the business in the room, this is my pitch. So I think we could imagine that there might be a case for investment funds having a passive presumption, so that pension funds should actually sort of start from the presumption that they should go passive, unless they can articulate clearly why they think that decades of academic research are irrelevant to them. And I'm not quite sure about the leads of this role. I think Leonardo DiCaprio has to be in any one of these, but I'm not quite sure what role he plays. Probably an investment consultant. Hugh Grant would be a sort of asset manager, I think, because he's that sort. You know, he would do rather well. But I think that it would be maybe there is a role for this, because I think that there are potentially billions of dollars at stake. Thank you very much.